That's another really good inflation report we got today. It's Wednesday, July the 15th, and this is Markets with Megan. If you like this podcast, you can subscribe to it. Hit that alarm bell. You can share it with your friends, family, colleagues, anybody who's interested in the economic data, the headlines you read, and what it means for your investments. Well, this morning we received the Producer Price Index, and this follows yesterday's Consumer Price Index. This is basically what the costs of the inputs are into the goods and services that we buy. This data came in much better than expected. When you look at it in the headline level, the expectation was for it to be basically flat this in the month of June, but it actually declined by 0.3%. That's the biggest decline we've seen since October of 2023, and we had downward revisions to the prior month as well. Now, we know these headlines are being very much impacted by the decline in energy prices. We saw energy prices down 6.4% for the month of June in this index. When we strip that out and we look at just if you strip out all the volatile items, that's food, energy, and trade, we saw prices only rise 0.1%. So that's been a very soft reading. The expectation was for them to rise 0.3%. Now, on a year-over-year basis, we're still seeing the inflation at a troublesome level here. It did come down on the headline level. It's growing 5.5% now versus 6% last month. Still not great news, but we do know that headline's mainly driven by the big increase in energy prices. When you take out food, energy, and trade, that's stuck here. It's growing 5.1% on a year-over-year basis. So that matched last month's reading. Again, it didn't go any higher, but it still isn't going much. It's not going much lower. So it's something that the Fed's going to pay attention to. When we dig into the details here, from the service side in this, which is important, we did see that come in better than expected. And that's really two different things. Portfolio management fees were much weaker than anticipated. And that has to do with the weakness in the equity market. That's probably going to reverse itself as we go forward. And then airline fares came down as well. That's different than what we saw in the Consumer Price Index yesterday. Transportation and warehousing costs as well. They came down 0.1%, and that has a lot to do with the decline in the fuel surcharges that we saw. So this report was better on the surface. We'll take it. The Fed's going to take it. It's likely going to keep them on the sidelines in their upcoming meetings. But there still is over a 50% chance that they'll hike rates in September. Part of that is because we're right back to where we were with this tension in the Middle East. Now, while oil prices aren't back to the level we saw, $100, $110 a barrel, they are a bit higher. And these measures are on a month-over-month basis. So it is something we may have some give back in the coming months, or at least quite a bit of volatility in this data. So for now, the Fed's on hold, but we still think it's likely, like the market does, that we may see a hike as early as September because of this data. That's all we have today. If you want a history of our podcast, you go to marketswithmegan.fm. Thank you.